In 2026, the world is about to do the same trick again, and it will make you poorer while you still feel like you did everything right. You will hear that prices are stabilizing, interest rates are coming down, the economy is getting better on paper. And then you will notice your paycheck buys less, rent eats more, and your debts grow faster than your life does. This is not financial advice. This is financial education based on how money actually moves when the Federal Reserve pulls levers, when banks need liquidity, and when wealth concentrates at the top. If you keep believing that your effort automatically turns into security, you are going to keep getting surprised by outcomes that were designed. Here is what you are really going to learn in this video. When global central banks print or create liquidity, it does not simply mean everyone gets richer in equal proportion. It means the people who already own assets get to buy before prices move, while the people who earn wages keep paying the price increases afterward. And in 2026, with inflation damage lingering and AI reshaping jobs in a way that targets the middle class first, the gap is widening faster than most people can emotionally handle. Let me start with a question that should make you uncomfortable. If the United States prints more dollars, do you think you automatically get a slice of that new money? Or do you think only certain people get the first pour and the rest of you get the bill later? Because that is the core mechanism behind printing fever. It is not magic, it is arithmetic, and it is ruthless. You have probably been told a comforting story your whole life. The story goes like this: governments manage money for stability, inflation is temporary, markets correct, hard work pays off, and if you play by the rules, you will eventually win. That story is soothing, and it is also wrong. And here is the dark part nobody wants to say out loud. When money creation expands, your purchasing power can fall even while the number of dollars in your account goes up. You can earn more and still be poorer, because what matters is not the label on the bills. What matters is what those bills can buy relative to everyone else. Picture a 30-year-old nurse named David. He works nights. He picked up overtime when his rent went up. He watches every price the way you watch a slow leak in a boat. He got a raise in 2025. It felt good for a week. Then 2026 hit. His grocery bill rose again. His insurance went up because climate-driven disasters have made the insurance market a mess. His credit card interest jumped because the banks kept repricing risk, and suddenly the raise felt like a cruel joke. David did not get lazier. He did not suddenly become stupid. He just entered a system where the cost of living moved faster than his wages, while the first beneficiaries of liquidity were buying assets at favorable timing. And that timing is where the wealth gap is made. Now zoom out from David to the entire system. When the Fed expands money, the whole global cycle responds. Other countries follow. Investors reposition. Businesses adjust prices. Assets reprice upward. Wages adjust slowly. Debts adjust quickly. That is not an accident. That lag is where profits get harvested. The easiest way to explain it is to talk about dilution, because dilution is the same story across different settings. Think about ownership.
If a company issues more shares, the percentage owned by existing holders can fall unless they buy more. The same concept shows up when new money enters the economy without distributing evenly to wage earners. You can print money, but you cannot print fairness. And in 2026, fairness is the one thing you will not get. Let's get specific, because vague fear is not the point. The point is mechanisms. The Fed does not just print money in one simple switch. It creates liquidity through multiple tools: interest rate policy, asset purchases, balance sheet changes, and emergency facilities that can reappear when the plumbing gets stressed. The story most people remember is the rate cuts and the headlines. But your lived experience depends on credit conditions, bank funding costs, and who gets access first. After the financial crisis in 2008 and the pandemic in 2020, central banks around the world expanded liquidity aggressively. The speed increased, the scale increased, and then the world adapted to a higher baseline of financial support. Now, if you think that makes inflation a purely American problem, you are missing how currency and global capital work.
The United States issues the world's reserve currency. But money creation is global. When one large system loosens, the rest of the world either loosens too, or their currency dynamics tighten the flow in a way that forces policy responses. So even if you are not in the United States, you are in the ripple. And even if you see the dollar decline relative to some currencies, that does not mean the dollar becomes worthless. It means the exchange rate moves as relative conditions shift. Sometimes the dollar weakens, sometimes it strengthens, and often it stays powerful because global demand for safety, liquidity, and collateral remains high. But your actual reality is not the exchange rate chart. Your reality is your bills. When more liquidity hits financial markets, assets reprice. Housing reacts slowly because it is sticky, and because constraints and supply issues interact with policy. Businesses respond quickly by raising prices where they can, and wages respond slowly because negotiating power is limited, especially now with AI-driven automation pressure and labor market fragmentation.
In other words, the new money tends to reach the asset side first, then the consumption side later. By the time the effects touch your paycheck, the purchasing power damage has already happened. That brings us to the next uncomfortable truth. In 2026, the economy is not just dealing with inflation. It is dealing with a job market reshaped by automation. You have seen the debate, the useless class debate, the claim that AI will replace jobs, especially middle-income administrative work, repetitive customer service roles, basic legal drafting, entry-level coding tasks that used to get outsourced to humans, and chunks of marketing operations. In 2024 and 2025, many people thought AI would just augment tasks. In 2026, the layoffs and hiring freezes show the real outcome. Employers do not need to eliminate entire jobs to harm you. They only need to reduce hiring, increase required output per worker, and push part-time and contract labor to offset costs. A big chunk of the middle class gets squeezed because the labor market becomes less stable. And less stability means higher reliance on credit. Higher reliance on credit is where the printing story becomes personal. Because once your income becomes less predictable, your household stops being a cash flow story and becomes a debt story. And debt is where money creation transfers wealth upward. Now let's talk about interest rates. Because this part will either make you furious or make you finally understand why your life feels more expensive than it should. You probably heard that the Fed started lowering rates in 2026. Maybe you heard there were cuts. Maybe you heard the policy is less restrictive than it used to be. And if you only look at the headline policy rate, you might think relief is coming. But then you look at your credit card, or you look at your auto loan, or you look at the refinancing options you were offered, or you look at your mortgage rates, whether you are buying, moving, or stuck in a period where you cannot refinance because your credit profile and the market spreads did not cooperate, and your rates are not coming down the way the headlines suggested. So what's happening? The reality is that lower Fed rates do not automatically translate into lower consumer borrowing rates. Banks reprice risk, funding costs change. Liquidity stress shows up in specific channels before it shows up in others. If bank balance sheets are under pressure or if deposit growth is weak, banks can keep charging higher spreads to protect their margins. And in 2026, banks have a reason to protect margins because the risk environment is not uniformly calm. Some sectors are fragile, some borrowers are failing earlier, the unemployment mix has changed, and insurance disruptions tied to climate-driven catastrophes are pushing households into credit dependence. Let me tell you a micro-story that is closer to the truth than most people want. Imagine you are trying to rent an apartment in a major city in 2026. You find one that is within the range of your budget, barely. You apply, you get approved, but you are offered a different terms package than you expected. The landlord requires a higher security deposit because the building's insurance costs surged, or you need to buy furniture immediately and you do not have cash, so you put it on a credit card. Then the interest rate hits. The bank is not just charging you interest, it is charging you for risk in an environment where the economy is not stable for people like you. It is charging you because they expect that a fraction of borrowers will default and they will be right enough to justify the rates. Meanwhile, who benefits from Fed easing? It is often the people with access to asset purchases, institutions, wealthy individuals, and corporate balance sheets that can borrow at better terms because they can post collateral and because their credit risk looks different. This is the disconnect you can feel in your bones. One side gets cheaper money in the form of financing and market liquidity. The other side pays for risk through higher consumer rates. And then there is a final layer that makes it especially ugly. When banks do not have enough liquidity in the system, their options narrow and their behavior becomes more defensive. You might remember the emergency tools from 2020, facilities designed to keep the financial plumbing from freezing. In stress periods, central banks can provide direct liquidity to banks against collateral. Those programs are not meant to be marketing campaigns, they are meant to be backstops. In 2026, as conditions fluctuate, you can see signals that liquidity stress is not fully gone. Some facilities are quiet for a long time, then suddenly get used again. That is the moment when professionals pay attention because they know what it implies about internal funding conditions. And when you combine that with consumer credit stress and a labor market that is less secure, you get the same pattern. Lower policy rates do not fix the lived reality. They can even worsen the incentives for banks to extract profit from riskier channels. Now here is a pattern interrupt. Close your eyes for a second and think about your last credit card statement. Not the minimum payment, not the due date. Think about the interest rate printed on it, the APR, the number that determines whether that debt is a temporary inconvenience or a long-term trap. If that number is above 20% in many cases, that is not a little expensive. That is a system designed so that paying down principal becomes extremely difficult unless you have a lot of extra cash flow. Now connect that to inflation damage that never fully reversed. Even if inflation came down in the way headlines measure it, the cumulative damage to purchasing power is long-lasting. In many Western economies, your salary today buys less than your salary did in 2019. That is not a theory. It is a measurement of cost of living growth, rent growth, energy shocks, and supply chain disruptions that got priced into daily life. So you are not starting from equilibrium. You are starting from scar tissue. When you add AI disruption to jobs and housing affordability crises to the mix, households become structurally more credit dependent. Housing prices detached from wages for a reason: policy, supply constraints, investor demand, low-rate eras, and financialization. By the time wages catch up, asset holders often already extracted the gains, and in 2026 the housing story gets darker. Insurance markets are collapsing in certain regions. That means property owners raise rents or reduce services. That means you move more often, which means you pay more deposits and fees, which means you rely on credit even when you never wanted to. So yes, the Fed lowering rates can happen, but your mortgage and your card interest are not the Fed. They are the outcome of bank risk pricing and household balance sheet stress. And here is where the story returns to dilution again. When new money enters the economy, it often enters through the financial system. It enters into asset markets and into borrowers with collateral. It enters into sectors with balance sheet strength. It enters into companies that can refinance. It does not enter into your bank account on day one with a fair allocation. So if you think money printing is shared, ask yourself a harsher question. Why do the richest people keep getting richer faster during easing cycles? Why do equity markets and real estate sometimes rally while wage earners keep feeling like they are treading water? Why does the top 1% own more than ever in many countries while the median person feels one emergency away from bankruptcy? The answer is not that the wealthy are smarter in some magical way. The answer is that the wealthy are positioned to receive new money first and to benefit from asset appreciation before the rest of society catches up to higher prices. This is how wealth concentration accelerates. It is also why AI could be the final nail for the middle class, because AI reduces the bargaining power of labor in many tasks. And when bargaining power falls, wages stagnate while costs keep rising. And when wages stagnate while costs rise, households borrow more. So the printing fever you hear about is not just a macro story, it becomes a micro trap inside your wallet. Now let's get into something that sounds technical but matters directly to your life. The idea that printing intensity must be compared to output, not just compared to itself. People obsess over how much a country printed in absolute terms. That is an amateur mistake. What matters is the ratio between liquidity expansion and GDP, because that ratio determines how much new purchasing power hits the market relative to goods and services. A small increase in money against a shrinking or stagnant output can create more inflation pressure. A huge increase relative to output can create asset bubbles, credit excess, and eventually dislocations. In 2026, global debt levels are enormous. Total global debt has exceeded $300 trillion, and it keeps climbing in many jurisdictions. Debt itself is a hidden form of fragility. When debt is large, the system is more sensitive to interest rate changes, refinancing risk, and liquidity stress. And when debt is large, coming down rates can be less about recovery and more about postponing the next crash. So you get a cycle. The Fed lowers or supports. Markets rise, wealth concentration increases. Then consumer costs remain elevated. Wages do not catch up quickly enough. Households borrow to bridge the gap. Banks earn through spreads and fees. And when the next shock hits, those households are already stretched. Now here is where the open loop resolves, because you deserve to know what happens when the printing cycle returns. Earlier, I said central banks can expand liquidity, and the first recipients are typically the people with assets. In 2026, those people do not only benefit from asset appreciation, they also benefit from the ability to borrow against their assets at relatively low rates when policy is supportive. While you are working for hourly wages, they are borrowing against collateral, then parking capital in diversified portfolios that tend to profit when liquidity rises. That is why the charts can look great while your life feels like it is getting harder. This is also why the passive income dream keeps circulating on social media. You hear that you can build wealth by investing a little every month, by earning interest, by generating income online, by flipping content into a stream. But here is the uncomfortable truth. Most creators in the creator economy earn zero. The distribution is brutal. A tiny number earn meaningful money, and the rest generate content without building real financial resilience. Many are rewarded with exposure, not cash. And when the algorithm changes, their income vanishes. That makes them even more reliant on credit, which makes them even more vulnerable to high interest rates. If the printing fever returns in 2026, the wealthier and more asset-heavy portion of society will convert liquidity into gains. The wage-dependent portion will convert inflation and debt into stress. So who is sacrificed? You already know the answer. It is you. It is not because you are the main character and the system hates you personally. It is because you are the easiest target. You have the least negotiating power, the fewest assets to borrow against, and the smallest ability to hedge against price shocks. Now let's pull the thread even further: housing.
If you've been locked out of buying a home, you are not imagining things. In many Western markets, home prices became permanently detached from wages after years of low rates and investor demand. Even if rates fell in some periods, price levels did not return to wage alignment. Housing supply constraints, zoning, construction costs, and capital flows kept prices supported. So a generation is being pushed into renting longer than any previous generation expected. But renting has a weakness. Rent resets. Rent responds to market rates and landlord costs. Rent responds to insurance disruptions. Rent responds to property taxes. Rent responds to credit conditions and refinancing needs. So while your wages negotiate slowly, your housing cost can jump quickly. And if you are forced to move, your transaction costs and deposits become immediate financial shocks. Now layer in 2026. AI displaces jobs, especially routine tasks. Climate disasters push more migration within and across countries. Insurance markets restructure. People get priced out, then move again, then borrow again. This is not an abstract economic model. It is your actual calendar filling with expenses.
So what does the money printing fever do in that context? It pushes asset prices up and makes it harder for you to escape debt by buying security. Meanwhile, it makes you more likely to rely on high interest credit, and it rewards investors and property owners and institutions who benefit from liquidity. You are paying for the system's liquidity in the form of higher costs, while you are not receiving the early liquidity benefits. Now we are ready for the darkest understanding, because it connects interest rates, bank behavior, and why Fed support sometimes feels like it makes things worse instead of better. In a healthy system, when policy rates drop, consumer borrowing costs should eventually fall too. In a simple model, cheaper money flows from banks into households, stimulating demand and growth. But in a stressed system, the channel breaks. Banks can lower their borrowing costs, but still charge high rates because the risk of default increased. They can also face funding constraints. Deposits may not grow fast enough. Liquidity buffers may be stressed, and emergency facilities can be used when necessary, which changes incentives for how banks manage balance sheets.
So what do banks do when they cannot lend cheaply to everyone? They charge more where the risk is highest, which is often precisely the households who need help the most. That is why credit cards remain expensive even when the Fed has started cutting. That is why mortgages can be sticky and why refinance opportunities can feel non-existent. It is also why the official story of the economy improving can coexist with higher household stress. The system can be stabilizing at the financial level while deteriorating at the human level. So congratulations, you are living inside a system where stabilization is not designed for you. It is designed to keep the machine running. Now here is the cliffhanger you need to hear before you dismiss this as just economics. If the printing fever returns in 2026, and if the Fed has to support banks again because liquidity risk reappears, then the next wave of money creation will likely hit the economy through financial markets first. That means the asset side can get a fresh lift, and that means the temptation for governments, corporations, and investors will rise to chase returns. When chasing returns meets fragile household balance sheets, the system becomes more unstable at the exact moment you assume it is safer. Because the more money you print into a system with debt and inequality, the more it trains people to treat risk as if it will always be rescued. And when risk is always rescued, people take more of it until the rescue stops. So what should you do with this knowledge? I am not going to tell you to buy a specific asset. That would be irresponsible, and it would also be pointless. The real empowerment here is a change in how you think about money cycles. You need to stop believing that inflation is a one-year story and wealth accumulation is a fairness story. Instead, you need to plan like an investor, even if you are not one by profession. You need to protect purchasing power. You need to reduce dependence on high-interest credit. You need to build redundancy in your life so an AI-driven layoff does not become an emergency. Now, let me give you a practical mindset shift that feels almost too simple to be true. Treat your life like a portfolio, because that is what money does to you when the system changes.
If one income stream is vulnerable to AI, diversify your income sources. If one expense category is volatile, create buffers. If one debt category grows faster than your ability to earn, treat it as structural danger, not as a personal failure. You are not lazy. You are not stupid. You were just never given the real playbook. The real playbook is not about hustling harder. The real playbook is about understanding who receives new money first and who gets the costs last. Now another pattern interrupt. The most dangerous lie is not money is unfair. The most dangerous lie is money is fair enough if I work hard. Because in 2026, AI is not just replacing tasks, it is replacing leverage. It is shrinking the category of jobs where your effort automatically increases your bargaining power. That means the old social contract is breaking for the middle class. So when money printing returns, the old contract breaks faster. And that is why this video is not about predicting a chart. It is about preparing your brain to stop expecting rescue. Now let's zoom into the most important strategic question. When liquidity expands again, where does it go?
It goes into markets that can monetize it quickly, like equities and real estate. It goes into sectors with balance sheet access. It goes into investment strategies that benefit from rising asset valuations. It goes into financing mechanisms that reduce risk for institutions. Retail investors are invited to participate later, after prices move. That is not generosity. That is distribution. It is a way to turn public hope into private profit. And in 2026, even crypto is not immune to the same pattern. The promise was decentralization, freedom from banks, a new financial system. In practice, regulation tightened, institutional involvement increased, custody and market making centralized, and much of the activity migrated toward entities that can access liquidity at scale. Retail investors often get the volatility while institutions manage the flow. So when money creation rises, the winners are not always those who believe the dream. The winners are those who have the plumbing. Now, remember the child in the analogy earlier? Clothes size at age 3 versus age 18. The point was that economic output grows, so the money supply needs to fit.
But the deeper point is that fitting does not mean equally distributed. If the system adds money like clothes for a growing child, it does not guarantee that the child who already needs new clothes receives them first. It means the economy keeps expanding. The distribution determines whether you get the clothes or you just pay for the tailor. In 2026, the tailor is the financial system, and you are often the one holding the bill. So here is where I give you the sliver of empowerment, not as hope, but as clarity. Clarity means you can stop reacting emotionally. You can stop assuming that rate cuts automatically mean your bills will improve. You can stop assuming that job gains or headline GDP equals your household security. You can stop assuming that if the market is up, your future is up. You can start asking better questions. Who benefits first when liquidity expands? Do you have collateral? Do you have stable cash flow? Can you reduce your dependence on high-interest debt? Can you create multiple income pathways that AI is less likely to compress into one replaceable task? You can also ask the brutal macro question. If global debt is above $300 trillion, and if demographic pressures increase retirement stress, and if climate disruptions keep reshaping insurance and migration costs, how many times can a system be stabilized before it needs to intensify the next cycle? That answer is not comfort, but it is information, and information gives you leverage. Now let's connect it to retirement and the final betrayal most people ignore. Social Security in the United States is under funding pressure, and the political response keeps pushing solutions further away. In many Western countries, retirement ages rise, benefits adjust, pensions are underfunded, and people are forced to work longer while dealing with higher living costs. So the money cycle is happening while you are aging into a period where you need stability. That is exactly when you should not be relying on the hope that markets will rescue you. If the printing fever returns in 2026, asset prices may rise. But retirees and near retirees often do not have the same ability to convert asset gains into stable income. And if inflation damage has already reduced purchasing power, you can feel poorer even as markets perform. This is the cruel math of the last phase of life inside an unequal system. So your call to action is not watch more finance videos. It is not hope for a rally. It is a decision to protect your household from the next liquidity wave the same way you would protect your home from a storm you see on the radar. Reduce the damage, increase optionality. Build buffers. Learn to read debt risk and credit pricing like it is weather. Because weather does not care if you want it to be sunny, and money cycles do not care if you were a good person. If you still think the system is going to take care of you automatically, send this video to someone you know who is relying on that belief. They need to hear it before the next wave hits, and before it becomes too late to change how their household survives. If you changed how you see money, subscribe. I put out one of these every week, and most of what I cover, you will not hear anywhere else until it is too late.